Thanks for joining. A lot going on in the world today. Wanted to spend this time talking about what we're seeing and thinking, and then importantly, how we're positioning client portfolios. Before we start, three broad themes that we think we observe today and that will persist on a go-forward basis. First of all, debasement. Far too much debt in the world. We continue to print more money that we don't have. It's not just a US issue, it's a global issue. Secondly, the offshoring that happened for 40 years, moving goods and manufacturing mostly to Asia, is now starting to not only stop but reverse. And then finally, the incredible amount of innovation that we're seeing in robotics, artificial intelligence, and healthcare is something we want to be a part of. So let's start with debasement. We have a global spending problem. US debt is now approaching $40 trillion. It's a big number, it's even hard to fathom. Japan's got similar issues. Europe's got issues, China has issues. There's really no one in the world that's actually living within their means. What that ultimately means is our currencies buy less. So it's the stories of our grandparents buying a loaf of bread for 10 cents or a house for $25,000. The value of what we earn and what we save is worth less and less over time from a purchasing power standpoint. So how do we get ahead of that? We ultimately need to own assets that appreciate over time and hopefully appreciate faster than inflation. We don't think this is a Democrat or a Republican problem. This is a government problem. It's been happening since Roman times. So let's accept it, and then we need to move forward as to what to do with it. Here's the rub. The cost of our interest expense is now rising higher than our military budget. It's actually more than Medicare. And it's starting to approach the total money we spend on Social Security. At this rate of change, it becomes less and less sustainable over time. So we either need to have higher inflation or much higher productivity to address this issue. This is why we have such a focus on yields. With yields going up, the cost of the interest to governments becomes more and more expensive. That's why we're seeing such pressure from the administration and what Secretary Bessent is trying to do to increase productivity and ultimately get yields down. The jury's out on what new Fed Chairman Warsh will be able to do over time because they want to fight inflation, but they ultimately need lower rates. Well, what happens if you keep putting more money into the system? You keep putting more money into the system, that $30,000 house becomes $300,000, and maybe one day it becomes $3 million. The more money we put into the system, the bigger the denominator, and assets generally appreciate over time with more money supply. We do not think this is changing. Money supply continues to grow in mid to high single digits per year, and we would expect that going forward. Again, want to own risk assets. Part of risk assets is gold. And I want to point out on this slide, in 2022, we saw a real break in buying of treasuries. And this is when the US seized Russian treasury assets at the point when they invaded Ukraine. So Russia thought they owned treasuries, and the US basically locked them up through the SWIFT system. So our friends, frenemies, and enemies all decided to keep purchasing more gold and much less treasuries. So let's put this in perspective. There's actually now more gold than there is in dollars. Believe it or not, there's more Chinese renminbi than both. And then ironically, way down on the right-hand side, there is Bitcoin. And some may argue that Bitcoin is a call option on gold. Maybe, maybe not. Final asset in the debasement bucket is Treasury inflation protected securities. They're like treasuries, but you do get the benefit of increased value if inflation actually exceeds expectations over time. Therefore, when we hold true safety bucket assets for clients, we do want to own some TIPS as well as treasuries. The days of outsourcing manufacturing to Asia, mostly China, India, Vietnam, Malaysia, are quickly coming to an end, and in a lot of cases reversing. And this broader theme of reshoring, we think, has a lot of legs and is likely with us for at least the next 5 to 10 years. So let's start with tariffs. There's a lot of controversy on tariffs, but the thought behind putting tariffs on is to encourage manufacturing in the United States from abroad, making it more expensive to import goods, thus making it more advantageous to bring on manufacturing onshore. Are we going to build sneaker factories here? I sure as heck hope not. But we're seeing huge dollars being spent on chip manufacturing plants in Arizona, data centers across the country, military supply chains across the country, pharmaceutical precursors coming back to the United States, auto plants coming up from Mexico into the United States. So we're actually observing some of this starting to happen now, and tariffs are part of that incentive or penalty, depending on what side you're on, to facilitate that movement. What we're observing in artificial intelligence spending is like nothing we've ever seen. So in 2026 alone, we will spend more on AI from the big hyperscalers, and that includes the data centers and the chips and some of the R&D that they're doing that's capitalized, than the railroad build-out, inflation adjusted, or the build-out of the US highway system. And that's just 1 year. When you look forward, McKinsey actually estimates we're going to spend over $5 trillion, and there's a tremendous debate as to whether or not these spenders are going to get a return on that investment. We're not arguing that artificial intelligence is not going to be incredibly useful for those that use it and will increase productivity and scientific innovation and ultimately robotics, but there's a huge debate on if those dollars actually get a return. We're seeing this in total manufacturing growth in the US. Right now it's all tech. We're seeing signs, early signs, it's not showing up in the data yet, that some of the other spending, whether it's military, pharmaceutical, auto, electric vehicles, is coming up, but we're not seeing it in the data yet. All of this requires power. And if you look at what China's done, since they were the manufacturing center of the world, they increased their electricity production from a fraction of ours to 3x ours over a 25-year period. We need more power, especially if we're going to bring manufacturing back. And we're starting to see it. So US electricity demand consumption is now growing about 2.5% in the beginning of 2026. We were flattish for the 15 years beforehand, and that's expected to continue to grow going forward. So we want to be exposed to that broader theme. We don't necessarily want to pick the AI winner or the AI loser, but we want to own the picks and shovels that are going to win in this reshoring, electricity build out, reversal of globalization. So how do we do that? A few things. Silver, used in solar panels, used in electronics. Deficit in silver versus the supply. Nuclear power renaissance happening around the world. If you need steady 24/7 power, you really have three choices: coal, natural gas, and nuclear. And we're seeing a huge increase in permits, regulatory barriers being torn down, capital being made available to start the build out of nuclear power around the world. And it's not just the US, it's actually in full force in China. They're constructing 39 nuclear power plants as we speak. Europe, South Korea, Latin America, Middle East, and the entire Russian sphere. So we're really bullish on the prospects of nuclear power on a go-forward basis. If you're going to move electrons, you need copper. Until we figure out a new way to actually move electricity from one spot to another, whether it's electrifying transportation or data centers or moving power from one spot to another, ultimately you need copper, and that demand keeps growing with a lack of supply that we see today. And finally, natural gas. The US is blessed with tremendous amounts of natural gas. So much so, due to shale technology, that we've gone from importing natural gas to now exporting natural gas. We export around 12 to 15% of natural gas production today, and that's actually growing to close to 30% over the next 3 to 4 years from all of these liquefied natural gas facilities that are currently under construction today. These aren't permitted, they're shovels in the ground and they're being built as we speak. So with this huge demand of natural gas, we think there's potential optionality that the price of natural gas could go up dramatically. And to put that in perspective, European natural gas or Asian natural gas is 3 to 4x the price of US natural gas. So if we see some of that gap close, it's really positive for those producers. Platinum, also a precious metal, used to be more expensive than gold. Now it's less expensive than gold. You're seeing more jewelry being made in platinum and palladium for that matter. It's used in auto catalysts around the world. There's not enough of it out there. It's also used in other electronic forms. We like that as well. We'd be remiss if we didn't talk about what's happening in the Middle East. Oil, as of at least this recording, is around $100 a barrel in Europe. And we've seen fits and starts of tankers being allowed to pass through the Strait of Hormuz. Inventories are being drawn down. China just put a ban on helium exports, which is used for semiconductor manufacturing. There's shortages of fertilizer that have already not made it to fields for this planting season. And we need to monitor the situation closely. We are far from geopolitical experts, but we think that the potential risks here of lack of certain commodities are really meaningful for global supply chains. We have to start with artificial intelligence on the subject of innovation. We're talking about spending over $5 trillion over the next few years into AI, data centers, models, and everything adjacent. It is possibly the biggest technological revolution we've seen since the internet or even the invention of electricity. We're seeing some of the frontier models actually outperform human-level experts across multiple fields. One of the areas that we think benefits tremendously from artificial intelligence is once we have agents that are acting for us and transacting and making microtransactions or conducting business for us, that actually benefits blockchain, stablecoin, Ethereum, Solana, Bitcoin, and the entire blockchain ecosystem. We want some exposure there. The entire life science field is going to be an enormous beneficiary of artificial intelligence, which ultimately means the consumer should be a beneficiary to their health. Google's DeepMind AlphaFold won the Nobel Prize in protein folding structures, and there's more and more innovation here to come. We're really excited to see what some of these companies are able to do and the benefits to society on a go-forward basis. AI is not going to stay in our computers. It's going to be in our robots. But whether it's in a manufacturing floor or welding deep underwater in dangerous environments or drones doing deliveries, and it's not just the future, they're here now. AI has enabled robots to be incredibly useful. It's going to make businesses much more efficient and really improve the quality of all of our lives. Now that we've talked about the three themes, we want to talk about smart diversification. The S&P 500 is driven by fewer and fewer names. The top 10 names in the S&P 500 now make up 40% of that index. It's not an index of diversified names anymore. It's an index of a few stocks and then a long tail of much smaller positions. The valuation of the S&P, while expensive versus history, is actually not that bad if you equal weight all the members of the S&P. So the largest companies happen to be the most expensive. But when you look at it on an equal weight basis, we're actually closer to average over time. In the short term, valuation doesn't matter much for performance. But with a 5 or 10 year view, starting point valuation has significant predictive value on forward returns. And we need to point out that current valuations are above averages, particularly on the large cap side. Valuation's part of why we also want to own international stocks. One, they're diversifying, but two, they're currently cheaper than the US. And it's not just the makeup of those indices. When you look across each industry vertical, companies internationally are trading at a significant discount to their peers in the United States, which generally means the growth is similar, you're buying it at a cheaper level, and you're getting a higher dividend yield. Fixed income's a little trickier right now. While rates are higher, credit spreads, which means the extra you're getting paid to own something beyond a treasury, are at the bottom 10 percentile over history. That means you're not being paid much to take any sort of credit risk. And therefore, we're avoiding corporate bonds, we're avoiding high yield, we're avoiding other parts of fixed income. There are some select areas on the private side of fixed income that we do find attractive, but they're niche. Anytime we can find assets that have a high expected return with little correlation to the overall economy or markets, we get excited. So along those lines, we've employed a hedge convert arb strategy that we're really excited about. We have trend following strategies that often go up when markets go down, not always, but often do, and generally keep up closely to overall market returns over longer periods of time. We've recently added some exposure to California carbon allowances, where we think the downside is very limited and there's substantial upside as California tries to get more revenue in for their expense needs. And then finally, and very importantly, we've structured a tail hedge in client portfolios so that if we are to have a sudden and severe market downturn, that tail hedge can go up dramatically, giving us dry powder to buy distressed securities when we most want to. Now that we've talked about public markets, I want to spend a little bit of time on private markets. Yes, they can be expensive. Yes, they can be illiquid, but often they have higher expected returns, tax benefits, or can be non-correlated to the economy or markets. I know we just covered a broad range of topics. Please reach out to discuss anything in further detail.